Okay, I think we're about ready to start. Good evening and welcome to the LSE for this hybrid event. My name is Kirsten Sehnbruch. I'm a British Academy Global Professor and Distinguished Policy Fellow at the International Inequalities Institute here at the LSE. And I am very pleased to be here tonight to welcome Dr. Deniz Igan, Dr. Luiz da Silva, Pereira da Silva, and Dr. Benoit Mojon. To both our online audience and our audience here, thank you so much for coming, for being with us today. Start with Deniz Igan is Head of Macroeconomic Analysis at the Bank for International Settlements. She has held several positions at the International Monetary Fund, such as the Chief of the Systemic Issues Division in the Research Department, and is co-editor of the IMF Research Perspectives. Luiz Pereira da Silva is the Deputy General Manager of the Bank for International Settlements, and prior to that, he was the Deputy Governor at the Central Bank of Brazil, and served as Deputy Finance Minister at the Ministry of Finance and as Chief Economist for the Ministry of Budget and Planning. Benoit Mojon is Head of Economic Analysis at the Bank for International Settlements, and before joining the BIS, he worked at the Bank of France. He was head of the Monetary Policy Division from 2008 to 2011, then became Director of Monetary and Financial Studies and a member of the Eurosystem Monetary Policy Committee. In this event, our speakers will be discussing how central banks can effectively contribute to a more equitable society by deploying the necessary tools to deliver on their mandated objectives of price and economic stability. They will highlight the importance of taking inequality into account when designing and implementing fiscal and monetary policy. For Twitter users tonight, the hashtag for our event is hashtag LSE UK Economy. This event is being recorded and will hopefully be made available as a podcast later on, subject to no technical hitches. As usual, there will be a chance for you to ask questions after the event, both here in the audience and online via the Q&A feature at the bottom of your screen. So please let us know your name and affiliation before you ask your question. And bear in mind that we are particularly keen to hear from students and alumni during this event. So for those of you here in the theatre, I'll let you know when we start with questions, and you can just raise your hand, we'll bring you a microphone. And for the online audience, again, please provide your name and affiliation, and Peter will take your questions. We're going to try and mix and match questions from online and theatre audiences. But for now, I'm going to hand over to Deniz. Thank you so much for being with us, and welcome.
Well, thank you, everyone. Thank you for the introduction. Thank you for the organization. It's really great to be here. My remarks today are based on joint work with my former colleagues at the IMF, so the usual disclaimer applies. The views are mine, not of the IMF or of the BIS. So let me start with a very simple observation. And just 1 second. I'm having difficulty moving to the next slide.
Maybe the upper screen, the this one.
Okay.
Okay.
Okay. All right. Thank you. So the simple observation. Public interest in inequality has increased tremendously after the global financial crisis in 2008. So the audience is young, you may not remember, but that was the GFC 2009. And when you look at the Google searches for inequality, that's the red line, you see that it was pretty flat for a long time. but then it started increasing very rapidly. And this 2013 spike that you see there is the publication of Thomas Piketty's Capital in the 21st Century, which made quite a bit of impression in public psyche. But more recently, you follow the red line and you see then there's another spike with the pandemic, and then yet another spike with the surge of inflation in the second half of 2021. At the same time that interest in inequality was rising, we also see an increase in interest in central banks, and that's the blue line. Right? You see the fluctuations, but overall there's a trend that the public is more and more interested in what central banks do, who they are. And that, of course, also coincides with very aggressive monetary policy easing in response to the GFC. And this was mostly, as you see on the right-hand side, first the interest rate declines that happened right after. But what you don't see there, but I'm sure you're very well aware of, are also the unconventional monetary policy actions that many central banks had to resort to because of the damage that the GFC has done and because they hit the zero lower bound. So this weak and fragile recovery that followed the GFC also made monetary policy normalization there, and interest rates stayed low for long and lower for longer for an extended period. And just when we were trying to get off to the new monetary policy normalization path, COVID came, and there you see again the blues dipping, which meant that another round of monetary policy easing happened because of COVID and sort of hit the economy. Then in a remarkable reversal, the past year has seen one of the most globally synchronized and one of the most aggressive monetary policy tightening episodes that we are aware of in decades. So this coincidence of the extraordinary monetary policy cycle and inequality hitting headlines at the same time gave rise to a natural association in the public mind between central banks and inequality. Now, what I'm going to show you next is that notwithstanding the rising public awareness, increasing inequality is not a new phenomenon. When you look at the advanced economies in particular, you see that it has been trending up since at least the 1980s. The picture is a little bit mixed for EMEs, but definitely for advanced economies, increasing inequality has been there for decades. And at the same time, we saw global real interest rates being on a decline. And the neutral rate, the R star, central bankers keep talking about, is not observable, obviously, and estimation is subject to a lot of uncertainty. But whatever estimate you can come up with also shows a declining trend over the past few decades. And this coincides with the decreasing trend growth in productivity in advanced economies as well. So what I'm talking about, putting these two together, the inequality trend and the interest rate trend, the reason is that both of these long-term trends are actually driven by similar structural factors. And those are factors such as financial globalization, automation, and demographics. All these push inequality up and interest rates down at the same time. And as we know, these are evolving in the current environment, and it's difficult to say what the pandemic and the war is going to bring on that front. Now, important to remember, however, is that these forces are beyond the reach of monetary policy. Central bankers cannot directly affect those dynamics, but that doesn't mean that they can ignore them. Quite the opposite. They need to accommodate the implications of these forces for inequality and for interest rates in taking decisions to fulfill their mandates. And by fulfilling their mandates, they can support more equitable societies. So in the remainder of the presentation, I will basically discuss the channels through which monetary policy can have distributional effects. My focus is going to be on business cycle frequencies, short-term effects, and unexpected monetary policy actions, so monetary policy shocks, as we would call them. I will not cover issues related to R star, what the neutral rate is doing, as well as the relationship between the neutral rate and inequality and the feedback effects between the two. These are beyond what I'm able to talk about today. And my focus will also be on advanced economies and within country inequality rather than across countries. Of course, the conceptual channels and the evidence I'm going to talk about here have also implications beyond advanced economies, and they carry also some lessons for emerging markets. So let me tell you about the very stylized summary of the channels through which monetary policy can have implications for the distribution of income, wealth, and consumption in the economy. At the core is heterogeneity. Households are heterogeneous across a variety of dimensions. So that could be income and wealth. Obviously, we're talking about distribution here, but households are also different in terms of their age, their skill levels, in which sector they are employed, their marginal propensity to consume, how patient they are, what their preferences are, how well they are connected with the financial sector, or how much access they have. So there are many, many dimensions we can talk about. But income and wealth, at the end of the day, are closely correlated with many of the dimensions that you can think of. Just to give two simple examples, skill level is correlated with income, and wealth itself is correlated with age because it evolves through the life cycle of an individual. So you can think in that sense, the income and wealth dimensions as the main channels that reflect many, many dimensions of heterogeneity. And under these two main headings, the literature has identified 4 blocks that really matter. And let's start with the income part. And there we have households that have very different primary sources of income. Some of these sources may be more responsive to monetary policy than others. And I will talk in more detail on that. Households also have different levels of income, needless to say, and their wages and employment prospects, those in the bottom versus those in the top, can be very, very different in terms of also their sensitivity to business cycles and to monetary policy actions. On the wealth side, households are different in terms of what they owe as well as what they own, and different assets and different liabilities are affected differently by changes in interest rates. And finally, households have different levels of wealth, and changes in interest rates affect savers and borrowers in different ways. So as a result, we have different exposures of households based on their income and wealth status. And the net effect of a monetary policy action on a given household is going to be a combination of these different channels. It's important to remember that some of these channels can offset each other. They don't always work in the same direction. Now, what I talked about is only the partial equilibrium effects. On impact, something happens to interest rates, and through these channels, you see different impact on different households. Now, then, there's the general equilibrium impact, because agents in the economy make decisions how much they want to consume, how much they need to borrow, how much they can borrow. There are decisions on employment, decisions on how much to pay those employees. And then there's international side of things, and there's the current and financial account that move based on what monetary policy in different countries are doing. At the end of the day, all these effects and feedbacks that happen will also be affecting how different households are affected by monetary policy actions in their country. Now, those are compared to the first part that I talked about. The general equilibrium effects take longer time, as you can imagine. They take longer to be realized. Now, I will demonstrate the potential impact on different households, first looking at exposure and then relying on more modeling and empirical techniques. But just to add to the heterogeneity and the complexity of the channels, there are also sources of heterogeneous responses that come in the general equilibrium channel. And that's because when you're deciding to consume and how much to borrow, there are constrained households and unconstrained households. So that will matter. On employment and labor, skilled versus unskilled labor, that's going to make the difference. And on the current and financial account, tradable versus non-tradable sectors, again, is going to make a difference. Now, as I mentioned, exposure measures and then models and empirical studies. Now, what do we know from the data? Households derive their income basically from labor earnings, transfers, and capital gains. right? And what you see here for the US in particular, we're showing, but it's a similar picture in other countries as well. Capital income is especially concentrated and belongs to the top 10% of the income distribution. Households at the bottom receive most of their income from wages. That's labor wages, that's where it comes from. And workers at the low end and middle of the earnings distribution also face higher unemployment risk. What I mean by that, what you see on the right-hand side is comparing the unemployment rates for different workers at the different parts of the earnings distribution. And you see that, I'm not showing here, but take my word for it, those in the bottom 20% of the earnings distribution experience higher unemployment rates after the GFC. And as monetary policy easing kicked in and the economy started recovering between 2012 and 2016, you see also the decline in the bottom 20 was much larger. So what that means is that by stimulating demand and reducing unemployment, monetary policy benefits all, but it just happens to benefit the earners in the lower end of the distribution more, because they are subject to higher unemployment volatility. Now, turning on to the next channel, the balance sheet channels. On the asset side, the wealth of the top 10% in the US is dominated by equity and bonds. That's where you see the purple and yellow bars. And it's about 62% of the total. When you look at the EU, that's a different picture. So the share of top 10 share of equity and bonds in the top 10% of the distribution in the EU is only 23%. Instead, they hold the rich in the EU hold most of their assets in real estate. That's also true for the bottom and middle in both regions, both in the US and in the EU. Now, if we turn to the liability side, not surprisingly, given the portfolios of households, you see that the liabilities are again dominated by borrowing against real estate. And that's both the blue and the pink bars you see there. Now, that means by changing debt service on mortgages, central banks can have an impact on household disposable incomes. But as you can see, it's not equal across the earnings distribution again. And one more point there, you're going to see the bottom 20 in terms of liabilities differs quite a bit between the US and the European Union. In the US, these are the poor, and they have relatively less mortgage debt. Home ownership rates are lower, but the characteristics of the rest of their liabilities, so the loans, the yellow block that you see there is student and payday loans or loans of subprime quality when they are mortgage loans or car loans, which means that the bottom 20 tends to be more vulnerable to cyclical changes, both in labor demand and in risk because of the composition of these liabilities. Now, let me turn to, well, what does it all mean? Why did I show you all these pictures? Now, we do micro simulations. What does that mean is that basically we have the distribution of households and we shock them with some hypothetical scenario, right? And we start with the interest rate full of 100 basis points and look at the gains and losses that would imply across the distribution. And what you see is that it is pretty much in line with an individual's life cycle. The poor, again, the bottom 20, as well as the younger middle-class households, those are the pink bars, age 20 to 55, tend to benefit from a negative interest rate shock because they tend to be borrowers. The wealthy and middle-income older households with little debt, but large fixed income investments, such as bank savings, they are disadvantaged when interest rates fall, right? But at the same time, when interest rates decline, as you can imagine, the wealthy will benefit from the changes in asset prices because they tend to own those assets. So that brings me to the second exercise that we do. Let's look at the mechanical impact of a 10% increase in different asset prices, in equities, in bonds, in housing. Here, what we see is that higher equity prices favor wealthier households. So that's coming, all the yellow bars that you see at the top of the distribution when equity prices go up, the wealthy households are the ones, because they own them, are the ones benefiting. Higher house prices are a little bit more equitable. So across the distribution, we also see that higher house prices favor the bottom and the middle part of the wealth distribution. And especially in the EU, you see the benefits accruing to the median household, those in the middle. But you need to keep in mind that even tiny changes in the lower end of the distribution is going to make a big difference, right? So this is not saying $100 gain on the top and $100 gain in the bottom. But because the $100 gain in the bottom is going to make a big difference because their income is much lower, it will look like a big gain here. Now, bond prices, the blue bars, we don't see much of an action. So it's mostly coming from equity and house prices. This is just a simple way to show you how one needs to put together all the channels in order to get a full picture. It's just not changing one and then saying that's the impact, right? And how do we do that? We can put all the channels that I talked about together using a dynamic stochastic general equilibrium model with heterogeneous agents, and we compare it to the US in this case. It can be done for other countries as well. Obviously, I'm not going to go over the details of the model, but you can take my word for it. It's state of the art, latest in the literature, and captures most, obviously not all, of the distributional effects, the channels that I talked about. Now, what we do in this exercise that we say, okay, let's consider a monetary policy loosening shock and see what happens. Income inequality rises because the rich now benefiting from higher asset returns. And that's what you see in the left chart, right? The total response, the red line is going up, income inequality is higher. You look at wealth inequality, that's the middle panel, and it barely moves. When it does move, it is going up. So again, and this is on purpose, we are showing it all in the same scale, so you can see, even if the directions might be going one way, the magnitudes are going to wipe each other out. So wealth inequality do rise, but it's marginal, and the amounts are really, really tiny. And you may ask, well, if income inequality is increasing so much, why wealth inequality is not moving as much? The answer again is about the distribution, because the average household, when you look across, average household holds about assets worth 3 times their income. But at the top, that asset to income ratio is more than 12. When you look into the bottom, it's essentially 0. Right? So what that means is that wealth at the bottom is very, very responsive to any increase in income, right? But on the top, it's not sensitive at all. That's why you're seeing the income inequality increasing, but wealth inequality barely moving. Consumption inequality, and that's the right side, that is much more important for central bankers from a welfare perspective. Ultimately, it's not what you own if you're not consuming it and enjoying it, right? That's where you drive your utility from. And we see that consumption inequality actually falls. And that's because the poor consume disproportionately out of higher wages. And here, monetary policy loosening is helping with employment, is helping with increased output, and wages are increasing, and that's helping with consumption inequality. Now, given the limitations of what I showed you, as good as models, they still have their caveats. So what we do is let's take it to the data. That's the last thing we can do. And we use, again, US data, but similar studies, as I'm going to show next, arrive in similar conclusions. With the US data from 1980 to 2016, you can look at both conventional and unconventional monetary policy shocks. And what you see is that monetary policy expansion, as you would expect, increases employment and output. And as a result of these channels, it has very small effects on both income and consumption inequality, if any. There's, statistically speaking, there is nothing really significant here. Now, let's put it all together, those 3 sets of approaches that the literature has employed: microsimulations, modeling, and empirical analysis, different countries, different times, different techniques. The literature is still evolving, but let me tell you that a critical reading of it would suggest basically three robust findings. First is that the magnitude of the net distributional effect of monetary policy is actually very small. Even when studies find statistically significant results, the economic magnitudes are very, very small. Second, monetary policy loosening may actually decrease, not increase, inequality of income and consumption in the medium term. But this effect, again, varies quite a bit across jurisdictions. That's where you see different counter names in the chart, and there's a wealth formation going on there. That said, in the medium term, even though monetary policy could be helpful, in the short term, wealth and perhaps income inequality may increase. Now, before I move on, two additional points from reading the literature. Many cross-country studies you may come across is going to report an association between monetary policy loosening and increased income inequality. But what is actually causing higher inequality is not monetary policy, but it's the worsening of economic conditions. And this is something that Benoit and Luiz are going to talk more about. And from a statistical or econometric point of view, once you remove this endogeneity and just focus on the systematic components of monetary policy, then the association goes away. And the second thing to take away is that counter cases vary. I think it's not going to come as a surprise. Countries are different, and there are different structures. Labor market institutions, capital markets function different. The financial institutions function different. Policies are different. So of course, results are going to be different. Let me just point out Japan. Many studies looking at Japan come up with either no effect whatsoever or the opposite effect that's happening. And then digging a little bit deeper, you realize that that could be explained actually by the labor market institutions in Japan, the relative low rate of participation and relatively lower flexibility compared to other countries. So monetary policy's transmission through the employment and output channels is not as strong, and to be able to offset other measures. Now, what is the implication? What's the takeaway for central bankers? Basically saying that monetary policy should remain focused on macroeconomic stability. And why is that? Because if we burden monetary policy with objectives that it's not designed to achieve, we may end up undermining its effectiveness. Okay? And in general, that's an undesirable thing to do, but given the knowledge we have on the distributional effects of monetary policy, it seems to suggest that central banks should focus on macroeconomic stabilization. That's again not to say that policymakers can or should ignore altogether distributional issues when they conduct monetary policy. But within their existing policy frameworks, central banks should actually factor in heterogeneity among households, among firms, because these affect monetary policy transmission. Again, something Benoit and Luiz will tell you more about. The second implication is that monetary policy cannot be the only game in town. Distributional outcomes can be improved if there's concern that monetary policy is having societally unacceptable distributional effects. Then this could be improved when other policies actually support counter-cyclical monetary policy. And the exercise that we do, we consider consumption and consumption inequality with or without fiscal transfers. And we do see that if you do have fiscal transfers, they can undo any distributional effect monetary policy might have. Then you might ask, well, what type of policies we're talking about here? What can help monetary policy achieve its objectives while improving distributional outcomes? Well, the simple answer is that by policies designed for this very purpose. Just the four headings I'm going to mention there is the redistributive fiscal policies, not to only cyclical effects, but the trend increase in inequality. This is one of the most effective ways to reduce inequality of disposable incomes and consumption. And the picture you have there is showing that countries already do this, and they can do even better. Second, addressing skill gaps by enacting active labor market policies, training people, helping them find jobs, so that unemployment spells are not long, finding a job is easier, and finding better paying jobs is easier. Those can all reduce disparities in earnings. Remember the earnings distribution and how the bottom is more sensitive to what's happening in the economy and more sensitive to unemployment risk. Third, improving access to financial services would do the same for income composition and wealth. If the poor have access to bank accounts, if they can save, if they can participate in different asset classes, then you will not have as much disparities. And finally, the broader structural reforms to enhance flexibility in the economy, in labor markets, and remove constraints to mobility can also go a long way in achieving these. So let me end with a quote from Anne Haldane. I'm sure is no stranger in this crowd. In 2018, he wrote, "When it comes to evidence on the distributional impact of monetary policy, there are wide gaps in understanding and even wider gaps in perception." So more analysis and clear communication by central banks need to focus on filling these gaps in perception. And by doing so, it would allow monetary policy again to remain focused on what it does best. Thank you so much.
Okay, so the here.
You press escape on this one, or I press escape?
I think it is either this one. Yes. Interesting.
Really small.
Yeah. Yeah. Here. Information 9.
Kirsten.
For some reason it's not allowing me to go into full screen mode. Maybe we can just go full screen. Yeah, it's not doing anything. All right. Control L should be done. Yeah, it's not doing anything. I mean, perhaps if I scroll down with the mouse. Would that be okay? Look. I think, okay, so thank you, Kirsten. Thank you for hosting us on this discussion about several angles through which we suggest that central banks should consider inequality, heterogeneity in their roles as policymakers using monetary policy. So Deniz talked about some of the channels of transmission, and this work that we did with Benoit and other colleagues shows that actually the role of central banks essentially to ensure price and financial stability in a society should definitely also consider the effects of inequality on the effectiveness of what they are trying to do, essentially stabilization policies. And we are going to go a step further, show you that indeed there could be effects of persistence of inequality through the business cycle. that, yeah. That are important enough so that if the persistence is not addressed, then recessions get deeper, inequality persists, and therefore the work of improving welfare in societies that, after all, central banks should also be taken care of, is not addressed. So again, the disclaimer applies. Nope. Here.
There.
Yeah, and no. Where is the, okay. So guys, I think this is simply a reminder that you don't need to be recalled that there is a obviously very extensive and old literature on inequality, particularly because we realize that since the mid-80s, inequality has increased. There are many angles, both in terms of analytical work, but also policy work that has addressed this ways in which we see the reasons for rising inequality since the mid-80s. And the work has essentially addressed the issues that are more structural in nature, a slow-moving process, mostly due to technological progress, mostly due to the collateral effects of globalization. And even the BIS has addressed this in one of the annual reports that we produced a couple of years ago. And therefore, because of this more structural nature of the rise in inequality, most of the policies to address them, particularly in the books that I just pictured here, have been focusing on more of the structural effects, the structural policies to reduce inequality, education, training programs, the ways in which you can upgrade skills and so on, and so forth. Yeah, definitely, I don't know. Okay, the click is here. Now, even if you think of a more structural nature of policies, and these are, I'm sure, two books that you might have been going through here in your classes. Even if you think of the more structural natures of these policies, basically what is inside the black rectangle, minimum wages, savings, incentives, social insurance, income policy, some of the elements that Deniz addressed in terms of the challenge of transmission of stabilization policies, okay, through wealth and capital income and through wages, earned income. The most recent research, example, the last handbook on income distribution by Bourguignon and Atkinson said, look, even if you focus just on the structural, you need also to think a bit outside the box. The outside the box policies are the red triangles that you see around these well-known structural policies to address inequality. For example, can we change the direction of technical change? Can we think of guaranteed public employment? Can we think of minimum universal income policies, for example, right? Can we think of capital endowments that will be distributed across the board? Now, you can immediately see this, that we are not here in the domain of monetary policy. We're here much more in the domain of fiscal policies. But indeed, these are outside the traditional features that we consider when we look at classical structural policies. And another way that we thought about this, but this was many years ago, and at least one guy in the audience remembers that, well, if you want to capture, and Deniz mentioned that as well, the heterogeneity of agents, the way they sort of receive these macro variables, and it affects their income and their wealth, for example. One way to model this is to think of a sort of use the wealth of data that you have in household data surveys, for example, and try to sort of do a top to bottom approach where you shock your basic big data of households heterogeneity with, let's say, the macro variables that people are usually subject to. For example, inflation, for example, interest rates, for example, the way in which public expenditure is distributed across various agents. So this modeling strategy is one way to, at the same time, understand that structural policies will change the agents, and you can analyze and simulate that with the heterogeneity of household data sets, which are available everywhere in every country. And you use a sort of a top general equilibrium model that will then input these linkages variables and inject them into your household surveys and try to see how the distribution of income and wealth, but particularly income, changes in your household survey. So this is just a top-down approach, and we're not talking here either of especially monetary policy or fiscal policy. These are macro variables that you inject into your household data surveys, and you see what exactly makes the changes that it makes to your household survey. Now, as I think we were amply told, and you know that, the central banks not only have been looking at inequality and heterogeneity, but if you look at the speeches of all these central bankers, including ourselves, there's been a growing awareness that this is an important topic for the profession. And so what we are going to be showing you here tonight is an angle that is not structural. Structural policies are very important, but we're going to be focusing on something that we think has been a little bit overlooked by the more classical literature on inequality, which is the cyclical factors that drive inequality and could make inequality persist for a long period of time, and therefore create a vicious cycle that we call hysteresis of inequality. And we identified 4 new evidence of that. First of all, that there is this concept of inequality persistence, of hysteresis. They tend to, of course, rise in downturns, in cyclical downturns of the economy. Actually, even if you have some countervailing policies, this increase in inequality tend to persist. The second evidence that we would like to show here is that inequality, if you are in a more unequal country, recessions there tend to be deeper, therefore more damageable, do more damage for poor people. The third is that there is a trend that we identified since the mid-80s that is making fiscal policies, you know, the traditional structural policies that are supposed to address structural factors of inequality. Well, since the mid-80s, these policies have become less and less redistributive, and therefore they've been less and less countercyclical, and therefore they've been sort of leaving the burden of stabilization more on the hands of monetary policy and central banks. This was what we refer to as being the only game in town. So the traditional sort of tools that that policymakers had to address inequality, fiscal policies, were more and more left or less and less effective in addressing inequality, and therefore monetary policy has to take a bigger role. And finally, I think this is the sort of the big message that we want to pass here is that central banks should not be sort of worried about inequality just purely on moral grounds. I mean, although of course there is a moral dimension to that, but there is also a concern that if you are indeed in a more unequal society, the stabilization effectiveness of your monetary policy, your main tool to stabilize the economy, becomes weaker and weaker. So if you take these four factors together, there is a case for seriously, in addition to, of course, and considering the mandates of central banks, stabilize inflation and ensure financial stability, when you do that, you should take also into consideration heterogeneity, inequality, and the distribution of income in your society. And with that, I leave the floor to Benoit, and I show you that you have to click exactly on this little triangle here, otherwise.
Thank you, Luis. So before I start, I just want to mention very briefly, I'm super happy to be here tonight. I'm a former student of LSE, the father of a former student of LSE, and the cherry on the cake is another daughter of mine is here tonight, and it's the first time that I present my work in front of one of my daughters. I have three daughters. I will basically tell you where we are. So inequality has increased a lot over the last 40 years. That's within country inequality has increased a lot over the last 40 years. And so the conjecture that we make in this book that we did with Luiz and co-authors is that the failure of all the policies which are meant to reduce income inequality may be due to neglecting one aspect which is very critical on the occurrence of inequality and the increase of within country inequality, and this is a cyclical dimension of income inequality. So, and then what we do in the book is that we provide those four facts that show that indeed there is a very strong relationship, a two-way relationship between the business cycle and income inequality. So I will go relatively fast because some of those facts are known to you. Some are new, but we explained them. And so in this way, we will keep some time for Q&A in the session. Okay, so let me stress very briefly the outlines just to remind you trends in inequality, then the facts on inequality and recessions that we uncover in this book, inequality and fiscal policy, and then inequality and monetary policy. Okay, so that's within country income inequality. This has increased a lot. That's what we see in the middle panel. It doesn't mean that, you know, if you take a global perspective, it doesn't mean to say that poverty has increased. Actually, if you take a global perspective, poverty has declined, okay, over the last 40 years. But this went together with an increase of within country income inequality, whether you take a Gini coefficient or you take the top 10% share of income. So that's a share of income that goes to the 10% richest in society. And there you see in red for advanced economies in the middle panel, or in blue for emerging markets in the blue lines in the middle panel, that they've increased a lot. And we will focus on income inequality, which has increased a lot, because actually, if you look at wealth inequality over time for the same period, wealth inequality has not increased so much. Okay, and the main reason why wealth inequality has not increased is because most of households' wealth is held in the form of housing, and the price of housing has increased a lot. And typically 50% of the population or more would own their house, and therefore they benefited from this increase in the value of houses. And it's not the case that wealth inequality has increased over the last 40 years. So I'm not talking about the top 1% or the top 0.1% that Piketty stresses, okay, where, you know, Jeff Bezos is much richer. That's a fact. Okay, but we're talking about the 10% richest here. Okay, so let me move on to directly the first fact. So the econometric experiment that we did, so here we use statistics, and we were able to isolate 100 and to point to 182 recessions across 70 countries with data which start in 1980. So we can look at what happens to income inequality in the years that follow these 182 recessions. And what we show here is that on average, across these 182 recessions, income inequality, here we take the share of incomes that goes to the 10% richest, it tends to increase in the years that follow the recession. And you see that it increases persistently. The shares that goes to the bottom 50% income level in the population, this decreases, but you see that the confidence interval is much wider. So it's harder to estimate the share, but at least in terms of the share that goes to the 10% richest, on average across 182 recessions, this has increased, okay? And so that's the first fact that we stress is that following recessions, you have an increase in income inequality, which does not get reverted. It is persistent, and that's what we call inequality hysteresis. Let me go to fact number 2. We have a large sample of recessions, and we're going to be able to study the depths of recession by comparing countries, and we compare countries with different levels of income inequality. That's our second fact, actually, which I display here in 2 forms. You have 2 samples of countries on the left, a sample of 91 countries. And if we focus on larger economies, another sample of 29 countries, either advanced economies or EMEs. And there you have the response of consumption in those countries when there's a recession. And so the deeper, the more negative the response of consumption, the deeper the recession. And you see here that if you're a country with a low level of income inequality, so you're a yellow dot, say Sweden or Finland, the response of consumption is much smaller in the event of a recession than if you're a country with a high level of income inequality, say the US, for instance, or the UK, where income inequality is pretty high as well. The second type of experiment that we do is that we're able to compare the response of consumption in US states, because we have data on income distribution state by state, and we have 50 states in the US. So there we can see the state's consumption response following the 2008 recession, the great financial crisis. So on the right, you have New York, okay, Connecticut, which are states with a lot of financial industry. And on the left, you have agricultural states such as Arkansas, Iowa, Nevada, for instance. And so you see there that the more inequality, the more income inequality, the more negative the response of consumption as well. So on these 2 very different samples, sample of countries, sample of states in the US, you have this effect of inequality on the depths of recessions. Let me move to the third result. So there actually what we see in the data is that over the last 10 years, income tax has become less progressive, okay, than it was in the past. This is what you see, the tax progressivity, the red line on the left, has been declining on average across advanced economies. And on the right, what you see is that the replacement ratio of unemployment insurance has become less generous over time. Here we compare where it is in 2019, the red lines, to where it was in 2001, the blue line. And you see that the red line is below, which means that you get a smaller share of your income when you are unemployed in 2019 than in 2001. And what we show actually through regressions, I don't have time to show them. I just report here the scatter plots of the data, is that if you have a tax progressivity which is above the median of countries, actually you have a slope here which is bigger. And what is this slope? Actually, this slope is a response of primary balance or government revenues, if you prefer, to the business cycle. So it means that when the economy goes very fast, the income of the government or the tax receipts of the government is going to be higher, okay? And the primary balance, so the difference between what the government collect and what the government spend, is going to respond more to output if I have a more progressive tax system on the right than if I have a less progressive tax system on the left. And this is actually what I just described is actually what we call the countercyclical property or the stabilization property of a fiscal system. Is it the case that the deficit declines more or the surplus, the primary surplus increases more when the economy is booming, okay? And you see there that it depends on tax progressivity. Another way to show that is here for different levels of tax progressivity, you have this slope coefficient, which is higher and higher. Now, if I move to unemployment insurance, here it's not only that the slope is higher, is that the slope changes sign, okay? So to the right, if I have a more generous quote unquote unemployment insurance, I will have more countercyclical fiscal policies, while if I have a below median replacement ratio of the income of unemployed, actually I get then even a negative response. So fiscal policy which is not countercyclical. And we show that this is more due to expansions than recessions, but I don't have time to dwell on this. So basically, the takeaway on the fiscal policy, okay, our third set of results, and the study is online, and the slides, I guess, will be posted if you want to dwell more into the slides after the presentation. So what to take away is that when I put in place a less tax progressivity, or I reform the labor markets to have less generous unemployment insurance, a side effect of those reforms is that I will have more macroeconomic instability because my fiscal policy is going to be less effective, or what we call the automatic stabilizers of my fiscal policy are going to be less effective. A side effect for us as central bankers is that it increases the burden of stabilization for central banks through monetary policy. But let me get to the last result before I conclude on inequality and monetary policy. There, what we do is that we look again at how much monetary policy can stimulate consumption for different levels of income inequality. This is a sample of countries that we are using. So we are making this model across countries with different levels of income inequality. And actually, the ability of the central bank to stimulate output, okay, and to stabilize the economy by stimulating output is going to be higher for a lighter pink dots here, which corresponds to a lower level of income inequality, the Sweden and Finland of this world, than for the darker pink dots. Again, we could do the same using US states. So in a way, this is empirically cleaner because across the US states, you have a single monetary policy, which is decided by the Fed and which impact all the states of the US. And there again, you see that the lighter pink, which corresponds to lower level of income inequality, the effects of monetary policy is bigger. The effect of monetary policy on consumption is bigger than in the darker pink dots. So let me wrap up. So these conjectures that motivates these empirical investigations is that the cyclical dimension of income inequality has been neglected And actually, we show that there are very important cyclical dimensions of income inequality. It is persistent following recessions, what we call inequality hysteresis. Countries with higher level of inequality have deeper recessions. They experience deeper recessions. Less redistribution implies that fiscal policy are less countercyclical, and this as a side effect will raise the burden of stabilization by monetary policy, which are conducted by central banks. And for countries with higher inequality, they have less effective monetary policy. So with these four facts, we hope that we convince you that indeed one place to look at in terms of curbing this increase and possibly reverting this increase in income inequality, which undermines the cohesion of societies, is to look more closely at when they arise through the cycle and design policies that would be more adapted to this cyclical pattern that we see in the emergence and persistence of income inequality. Thank you very much.
Thank you so much. That was so interesting. I love the way the three presentations were so coherent. Okay, so we are now going to open the floor to questions from the audience here. Depending on how many there are, we might have to group some together. Anybody would like to start? Yes, you were the first hand up.
I stand up. Hi, thanks very much for that. My name's Ewan McGahey from King's College London Law School, also used to be here at the LSE. From a legal perspective, the mandate of the central banks is for price stability, as you know. It's a little bit different in the European Central Bank and the Fed. That the UK, the Bank of England has to follow the government's economic policy and for growth and employment. The European Central Bank is more focused on price stability alone. The Fed is supposed to balance with employment. And I've been thinking about, whether price stability can include inequality. And I see you're sort of looking at the empirical impacts. And I wonder if you could offer any thoughts about the extent to which inequality undermines price stability, because then you can say, from a legal perspective, that if the bank has a duty, central bank has a duty to safeguard price stability, but inequality undermines price stability, then you can say that the banks have to pay regard to inequality. Just one example or two examples is if inequality goes up, then rich people are buying lots more houses. That puts pressure on house prices rising. House prices rising is obviously not price stability, it's price instability. Also just inequality of incomes. I mean, you can say that the price for labor is growing more unequal with rocketing CEO pay, and maybe you could say that that's price instability as well. And I'd be very, very interested to hear any thoughts you have.
Thank you. In the interest of time, let's group questions together. Any other one? Yes, thank you.
Yeah, hi. As on a similar note, Stefano from you both started the presentation actually. Mandate. Thank you. This is better. But I failed to see how the two presentation would support either conclusion. In one case, the main message was central banks are not doing anything too bad on inequality. And in the first case is that inequality is making the job of central banks much worse and much harder. But surely in the second case, it will be easier to say, let the government do some of this changing in taxation. And in the first case, I failed to see how the connection with the central bank mandate is strong. So the last point on the conclusion, well, knowing that the central bank is not doing something actively bad doesn't mean that it shouldn't be trying to do something good.
Thank you. Last from the room? You would like to start?
There is a third.
Hi, my name is Rahul. I'm a civil servant, but I'm here in independent capacity. I was wondering if you could maybe expand a bit more on the comment made about endogeneity in the analysis. And I was thinking about the chart where you talked about Denmark and Sweden having low inequality. And so, monetary stabilization works more effectively in a recession, but isn't that where you have your endogeneity problem because they have low inequality because, or rather they have less declines in consumption during recessions because their incomes don't fall that much because their fiscal policy is more redistributive. So you've got a sort of a correlation versus causation issue in the analysis.
Well, maybe I can start with the first two questions that I think are interrelated. This is not an advocacy for a change in mandate, right? This is a evidence that you have objective factors that makes the work of central banks in stabilizing prices and ensuring financial stability more difficult. And therefore, I think that the argument that if you want to go into the policy conclusion side of it, is that obviously you need to pay attention with the coordination of other instruments in the array of policies that you have at hand. And particularly, Benoit was showing you the way in which fiscal policy has been less redistributive and less effective in addressing the issues that compound inequality, rather than sort of making the case that you should immediately think of an evolution of mandates, which is a discussion that society has to have. You have many other tools that are at the disposal of the regulator and central banks that can address some of the issues that you mentioned. For example, macroprudential policies. You can certainly have, in addition to the operations of monetary policy, if you're thinking of the possibility of bubbles, financial bubbles in your economy, in addition to the action of monetary policy, using what we were mentioning, a more redistributive fiscal policy on the one hand, coordination with the fiscal activity, the fiscal authority, the treasury, but at the same time, coordination with the regulator in the economy, which sort of is responsible for precisely through a number of macroprudential tools and microprudential tools to avoid the development of the type of risks that you rightly mentioned. So the issues that we are pointing out here are precisely issues that should alert policymakers about the benefits, the social welfare benefits of coordination of policies, both on the macroprudential side, both on the fiscal and fiscal and treasury side. You want to complement Deniz or Benoit?
Yeah, let me perhaps clarify on the mandate question. So what we are saying, I don't see a contradiction, because what we're saying is that the developments in inequality are primarily driven by forces that are outside what central banks can do, right? So after that realization, whether the mandate can or try to handle inequality is kind of a secondary question, I guess. And yes, most of the evidence that I showed is that when central banks are trying to do what they are trying to do, what they are mandated to do, we don't have definitive answer, no smoking gun, then they are doing harm, right? Which is important for central bankers. Now, whether they can do good, and it should be part of their mandate, as Luiz said, it's part of society to decide. But from a technical point of view, we need to also ask the question of whether they can do something meaningful. And that brings us back to the structural factors, because it's also important to design the mandate, and I don't need to remind to this audience, right? It needs to be something that the agency can influence, can do something so that they can be accountable for it. And I don't think we have enough evidence that central banks single-handedly can deliver on inequality. But let me stop here.
Yes, so let me reemphasize what is the most uncontroversial aspect of our results is that if central banks want to do a good job to deliver on their mandate, understanding better the business cycle and seeing how the business cycle is influenced by income inequality is certainly useful for them. Okay, so I think that's one of the messages that we have, and this one is completely uncontroversial. And I think we also clarified in the two presentations that we strongly believe that fiscal policy can do better, and fiscal policy may need to be adapted to business cycle circumstances where inequality arises. And if fiscal policy progresses in this dimension, it may make the mission of central bank easier to deliver on. But whatever fiscal policy does, central banks have to deliver on their mission, on their mandate. And in a majority of countries, it is price stability and financial stability. In terms of the question on endogeneity, the full-blown, absolutely clear-cut, pure exogenous factors is difficult to observe. So here, we are using the cross-section of country situation, and a first description of the data in those circumstances is showing that there is a difference across countries in terms of the depth of recessions, in terms of the strengths of the effects of monetary policy for different level of income inequality. It may be that indeed in those countries, there's less of an income decline because of more redistribution, but I think this is making our point. So I'm not sure I see a contradiction here. It's a good point.
Thank you so much. Peter, I'm going to read us questions from the online group.
So we have a question from Rafi Azari. How can these findings concerning the importance of fiscal policy be applied in the EU context, where there is a single currency without the fiscal union? The country-specific differences also make fiscal union a contentious subject, Northern versus Southern Europe, for instance. If this does support a fiscal union in the EU, how can this be implemented with varying differences at the country level without adversely impacting the single currency? And then I'll just read out another one from.
I'm not sure I fully understood the question, actually. Are we pushing for a fiscal union in the EU? Is that?
Yeah, I think it's asking, how would a fiscal union be implemented in the EU context?
Well, I mean, the union is progressing slowly. The fiscal union is progressing slowly, but progressing. There is a next generation EU package where several of the countries in the euro area will benefit from massive investment in the future, in infrastructure, in the green transition. So there is actually, if you would have asked me 5 years ago whether I expected to ever see joint liabilities of the member states of the monetary union, I would not have expected that, really, as a response to COVID, this development has been very much a breakthrough in my view. It's still in dimension, a relatively small one, but still it's a breakthrough. So there may be progress towards a fiscal union, further progress towards a fiscal union in the EU. However, I'm not completely certain this was a question I was asked.
Do you want to read the next question?
So the next question is from Yusuf Izik. Is the independence of the central banks important given the evidence presented by Deniz? specifically in regard to the role that banks need to assume in terms of consequences on equity and societal benefits?
I can take that. That's actually part of the reason that central banks need to communicate about inequality and what it means for them and where it fits in fulfilling their mandate. Because I started talking about the natural association in the public debate, right? You see two things going in the same direction, you're like thinking, okay, yeah, there must be a causal relation. And we know that that's not always true. And when it's not addressed through, public relations, clearer communication, that type of association in people's minds, in public mind, then becomes a threat to central bank independence, because people start questioning, why is the central bank not doing good? Why are they doing actually bad things, right? And then comes all the related moves for central banks to do something different and whatnot. So in that context as well, I would say this communication filling in the gap, both in terms of understanding better what it means for central banks, but also filling the gap in the perception and communicating to the public what it means, particularly in the counterfactual. If central banks don't do what they are mandated to do in the right way, what are the implications for inequality? That's the counterfactual that they need to communicate, and it's no easy job.
Perhaps just to add one important point, I think we all realize that the institutional feature that we have built so far of independent central banks capable of deciding with their policies, and particularly monetary policy, on their two mandates of usually price and financial stability, are essential and are very important. For example, we all know today that the first enemy is to fight inflation. We know that inflation is the worst enemy of the poor in any country, and therefore to have an agent that is capable of addressing this as its primary objective is an essential feature of institutions that have been built by experience, particularly now, not only in advanced economies, but also in many developing countries and emerging markets. I think the point that we're making here is that in addition to this, the strength of this institutional feature, the setup of policy responses to recessions, to policy responses to crisis should also consider the features that we had shown you in terms of the welfare enhancing or improvement, whether other supportive policies would help central banks precisely to achieve their goals. I think this is the sort of the way in which we should sort of think of the argument of what sort of objectives you should set and what sort of complements central banks could have in addressing their primary objective. You could, for example, produce the same type of debate and discussion about another very important topic of today's, which is climate change, the way in which central banks should sort of address this type of issue as well, right? It's beyond different from inequality, but in terms of the sort of the argument of what should you be concerned about this type of global externality is also an issue where coordination of policies and looking at other agents' objectives and how to complement your own policies with coordination is a increasingly present debate in the life of central banks.
Last question, or was that? Okay. Anybody else in the room? Last chance. Chico.
Thank you. Francisco Ferreira from the International Inequality Institute. Thanks a lot for the great presentation. I have one question to Deniz and one to Benoit, and I invite Luiz's comments on either of them. But to Deniz, so I may have missed this and misunderstood it for various reasons, including that my hearing in this room is terrible. But the sense I got was that you said in a number of your first results that although inequality is bad for various things, it makes fiscal policy less effective, it makes monetary policy less effective, it should inform it, but the actual effect of monetary policy on inequality has not been terrible, in the sense that, if I got that right, interest rate increases raised income inequality and it then fell back over time. Consumption inequality fell with either the same thing, yeah. And then contractionary, and therefore expansionary monetary policy presumably would have the opposite effect.
That's expansionary policy.
Hmm?
Expansionary policy increases. Expansionary,
Lead to an increase in
so expansionary monetary policy increases income inequality and decreases consumption inequality.
Okay, very good. It increases income inequality, but not wealth, right? No,
Not wealth.
no result.
It does, but it's very small in terms of.
Yeah. So, okay, the question I was going to ask, the income, I got the income, the sign of the income thing wrong, but the question I was going to ask about wealth stands, which is, if I got it right, most of your data went up until around 2016, 2017.
More or so, yeah.
And so, bearing in mind Lucas' critique and all of those different things, should we extrapolate those conclusions to the post-COVID era, when there was this massive quantitative easing, which in my mind at least, but I haven't done any analysis, might have led to an asset price inflation, which was beneficial to those who held assets, and the effects on asset prices in this last boom. I would have expected it to have been inequality increasing. So I don't know whether you've had a chance to look at that data. I've seen some literature that seems to go in that direction, but I may be wrong. So just inviting your comments on that, on whether you would extrapolate these results to the last 2 years or so of the pandemic. And quickly, sorry, I don't want to talk too long, but quickly to Benoit. So you answered, I think, an earlier question about identification and exogeneity by saying, well, look, there's not a lot we can do, so you're looking at a cross-section. But is there at least one of those ways to sort of separate the impulse response from trends? Because, there are trends, right, in inequality over time. So if you're saying this thing is persistent, it rises in recession, is then persistent, the least you have to do, I guess, is to sort of separate out the impulse response from the trend. So just a comment on that.
Yeah, very briefly, we do separate the trend. So what we show is what goes on in addition to the trend, and the years of that follows recessions are years where it's only a small part of the sample. It's I think less than 15% of the observations are recessions, and so we have a time fixed effect, and so we control for the trend. But I leave the last word to Deniz.
These are exactly the questions we asked ourselves. And Benoit and I were talking earlier, and he was asking, when did you start this analysis, this paper? It was before COVID. And our concerns were much more about the lower for longer, and our star keeps going down, and monetary policy needs to normalize. How? Those were the questions in our minds, and lo and behold, the pandemic comes and it changes the whole calculation. In the paper, we are much more careful in saying, let's not extrapolate, because we really don't know how the pandemic changed things. But maybe just a couple of words. One analysis that we have done was looking at what happens to inequality after recession, after pandemics. And of course, you need to also buy with a grain of salt, but purely econometric analysis, similar to what Benoit and Luiz have done, basically shows after pandemics, inequality does increase. And we have heard a lot of stories, a lot of anecdotes about that too. So there's that perspective and what macroeconomic policy can do in that environment. And going into that point, the second thing I would say is we didn't know March 2020 I've been in many rooms still on and then shifting to WebEx and whatnot, but literally brainstorming and trying to understand what can we do as central bankers, as fiscal policymakers, as financial policymakers. And this unknownness of unusual thing and trying to understand how it's affecting the economy, supply, is the supply shock, is the demand shock, is an uncertainty shock. So in that environment, I think I would argue rightfully, many policymakers have taken the insurance approach and did the most they can do, not knowing what was on the other side. So, but that's definitely a question that we need to study, and well, hopefully not the next pandemic, but next big shock, we will have some lessons.
Thank you so much. Thank you for all the questions. Thank you for the answers, and thank you so much for attending this event tonight. Sorry, I thought there was another sentence there, but there isn't. So just thank you very much.